Okay, so you can look up the ETFs and the options on ETFs, but we do not track the futures and commodities on Power Options. Okay, Asiva asked a question in regards to RadioActive Trading, the limited risk position discussed by Kurt Frankenberg, setting up a married put position going far out in time and deep in the money. And there's 12 different income methods that go along with that to make adjustments to the position, whether it's simply selling a call against the married put, doing a riskless spread trade. The bear call spread, for example, inside the context of the married put does not take on any extra risk. You still generate income and you leave the upside of the married put open. Masiva's question is, if I'm opening a married put, what are your thoughts on using weekly options? Well, there's nothing wrong with using weekly options in the context of a radioactive trade, provided they match the guidelines in the blueprint. If you do an income method wrong, excuse me, you can get yourself into trouble very quickly. Let me go back for a moment. I'm going to go into backtest under the married put tab, and we're just going to go back 5 or 6 days before this little run started. I'm going to go back to last Friday, and I'm just going to run a basic married put search. We're going to go back to February 19th, standard expiration, and we're going to use our radioactive screen. Okay. Now, the reason why I'm doing this is I just want to pick one of these married puts. Hopefully the stock has moved up. Let's take a look at PayPal. Last week, we could have opened PayPal, PYPL, at $35.76. And following the radioactive trading techniques, we might have gotten a little better price here. We're going to call it $7. We could have bought potentially the January 2017 40 strike put at $7. We're going to call it $7. Okay, so our total invested would be $42.76. We're guaranteed to get $40 back, so we're only going to risk $2.76. Okay, now let me go into the portfolio very quickly. I'm going to add this married put from last Friday in as a position. Okay, so we had PYPL. We would purchase 100 shares on February 19th. As I type it in instead of using the calendar. And our purchase price per share was $35.76. Now, at the same time, we would have bought to open a January 2017 40 strike put, and we're going to put in $7. And of course, we would use the same trade date. We would have opened these at the exact same time on 2/19. All right, let's go ahead and submit that into the portfolio. We are now tracking it as a married put position, but I want to do two things. First, we're going to go to the profit and loss chart. And here's our risk at 6.5%, the max we could lose on the position if we leave it all the way open in January, make no other adjustments, and the stock's trading below $40 per share, we'll lose 6.5%. Over the course of the next 11 months or so, we're probably planning on generating premium against this, adjusting the put option, and looking to lower this risk as the stock fluctuates in price up and down. That's where the 12 different income methods come in. Jim asks, did you choose this symbol because it had more open interest? No, I just chose PayPal because it was listed there, and this was a position that Ernie got into for a married put. I didn't do any analysis on this whatsoever. This is Ernie's position. I just grabbed it for our quick example here. Okay, Jim, we can maybe get into that a little bit later in the presentation after we get through some of the other positions as well. Mike's got a question coming in, creating a stop on a covered call. All right, now here's the married put setup. Now, the other thing I want to do is I want to go to the option chain very quickly. And we're going to go back in time as we did before. I want to go to February 19th. And let's go ahead and get chain. It's showing me the put chain right now because I linked from a put option. We're going to change that to the calls only. So on February 19th, we would have looked to sell the weekly calls following Siva's idea. And remember, we bought the stock at $35.76, but we bought the 40 put. Well, the 40 put isn't going to be worth anything. It's only going to be worth 5 or 10 cents. So the minute we open the position, something logical to give us a little bit of room might have gone with a 36, but that's right at the money. That's a bad time to sell a call, but the 36 would have been at 60 cents. Okay, and the 36.50, well, 35 to 50, let's go ahead and call that 40 cents if we got in at that price. Okay, so our 36.50 And the 37, maybe we could have gotten 30 cents before, but we'll keep the 36 and the 36 because they're the only ones that offer any real premium 1 week out in time. Let's go back to our custom spread builder. Viewing the profit and loss chart. Remember, we would have opened this on the 19th, so today's the expiration. So to get any value, I would have had to sell the 36 or the 36.50. Let's do the 36.50 at the 40-cent premium we would have been able to sell as soon as we open the married put. Okay, now, how did that happen? Remember, we originally only had a maximum risk of $2.76 or 6.5% when we opened our married put. That was 6.5%. Now, when we forced ourselves, we sold the 36.50 for only 40 cents. Why did our risk go up in price? Well, it went to the upside. Okay, the risk increased to the upside if the stock moved in the direction we originally thought it was going to move. So remember, with our stock plus our put out to January, we had an investment of $42.36. Okay, that's our total out of pocket. Yes, we're guaranteed to get 40 back, but the minute we sold the 36.50, we still have $42.36 invested. That's including the 40 cents. So our risk actually goes up to close to $6. Well, it's $5.86. Because if the stock gaps up, what's going to happen? We get no further advantage because of the call we sold for a measly 40 cents in premium. And as the stock continues to move up, this put is declining in price and we're getting no further delta advantage. We lost that by selling the call too soon at too low of a strike price and at too little of a premium. Okay, it goes against the rules in the blueprint. That's why we wouldn't do it. Now, the stock has moved up. Okay, we would have got in at 35.76 with the expectation the stock was going to move up. It's now at 37.49. We've gained almost $2 on the position, a little bit less than, about 8% or so, actually a little bit more than that. So the stock has moved up as we expected. Now that the stock has moved up, and it's trading at around 37.49, today, if I looked out to next week, I can still only get probably 15 cents for the 40 call. So maybe that is a reason to go out 2 weeks, 14 days out, and probably get 15 cents as well. So see, the premium's still not there. And if I sell the 38 call for next week at 40 or 45 cents, let's go ahead and sell that. Keeping our same stock price and our same put price, but we move the put up $1.50. Well, now our risk still goes up to 10.3. and we still cap our gain at 3.6. So if the stock continues to go in the direction I want, Siva, and in the next week or two it's trading right around 39, 39.50, that's when I might look to sell the 1 week out 40 call, or maybe even the 41 call, depending on the premium. But trying to force the position to do a weekly income method or sell a weekly call as soon as you open the married put, you're going to put yourself in a poor position. You're actually going to increase your risk to the upside in the direction you thought you were going to go. And again, you might only have that small gain on the position. Now, let me go back to the option chain. Hindsight's 20/20, and it's always fun to cheat and see what we could have done. But back on February 19th, when we got into the stock, remember, at 35.79, my apologies, and bought the 40 put, maybe I could have done something else. For example, hindsight 20/20, what if last week I bought one? Could I do this? No. Yeah, I can't even do an income method number 5 here and make it work, where you buy one and sell two. It just wouldn't work, so we wouldn't get the premium that we wanted. We'd be at 45 and 40 and 35 cents between the two. If we bought a 36.50 and sold two 37.5s, it would look pretty good, but at the same time, that wouldn't have worked. But we can do it. Let's say that we got into the 36.50 at 42.5 cents. We use the direct midpoint. And we sold two 37.5s, and let's call that 17.5. So we're going to do it a slight debit, but let's go back and take a look. Had we, let me go back a second. Remember, if we had sold, remember the 36.50 call we were talking about for 40 cents, it probably cost us 90 cents to buy it back today. So we gained the stock, it moved up in price, but then we'd have to buy it back more, and if we rolled out further, we'd have to make up for that. It's probably not worth it, although we did keep the gain in the stock. All right, so if I did the 36.50 and the 37.50, this is a ratio call spread, what we call income method number 5. I'm going to buy 1 and sell 2 to create a ratio call spread. Now I want to do this at a credit. That's not good. Let's get the right numbers in there. Okay, but this would be done at a debit, so I wouldn't have done it anyway. But hindsight 2020, we still increased our risk up to 10.1% to the upside because we sold 2 calls against 1 and 100 shares of stock, and we capped out not even good. The covered call would have been better because it had a higher potential gain if the stock ended right at 36.50. So, not even a good one there as well. All right. Yes, if you're selling the weekly options in that fashion, you're trying to force it in there, it still wouldn't do well. Okay, now Siva, I think you're looking at the wrong point. One follow-up here from Siva says, the only thing I can think is if we bought the put only 2 months out rather than several months out, that doesn't change the dynamic, okay, because you still have more invested. You never want to really sell a call below the put strike price. That's the hindrance. And if you want to get the single-digit risk, you're going to have to go slightly in the money. So February 19th, once more, let's check our available expirations. Let's go take a look at July. That's probably too far out. Let's go to April. Standard April expiration, 56 days away. My apologies, let's go to the puts only. Let's say that I opened the 37 put at a price of 270 for April. Okay, so let's clear this out. Let's go to April. 37 put, excuse me, and bought 1, what did I say, 270? Was that right? Yeah, 270. All right, so here we have a shorter term level. We've got a risk of 3.8%. Again, the stocks moved up about $1.80 from where we got in, but we already saw where the put is. We bought it at 270. The put's reacting more quickly. It's down to about 160 or so. So we've lost $1.10 on the put and gained $1.80 or so on the stock. Actually, it's about $1.70. So we gained about $1.70 on the stock, lost about $1.10 on the put. So we'd still have a profitable position. But same result. Notice here that our cost basis is $38.46. Remember what we saw for this week's expiration, that the 36 strike was only at 60 cents, the 36.50 was at 40 cents. So let's do the 36.50 again at 40 cents with the shorter term put. Our risk was only 3.8%, and it went up to 4.1 again to the upside if the stock went in the direction we wanted, because we're selling a call below our total cost basis for the stock and the put, and your max profit is only about 0.7% if the stock was trading right at 36.50, excuse me, at expiration. But as we saw, the stock went past that. It would cost us 90 cents to buy to close this call now. Oh, I'm sorry, I went to the wrong expiration. My apologies. Let's factor that in. Let's go midpoint at 90. So buy 1 at 90. So we're adding 50 cents back into the position. All right, so now our cost basis would be $38.96 for the stock and the put. And then, of course, well, let's just add the 50 cents in. I'm sorry, let's clear these two out. Let's add the 50 cents back in. This would have been the management. We would have had to roll it. So this would be $36.26 for our cost base of the stock. And now for March 4th, with the stock at $37.49, so we sell the 38 at 40 cents. And remember, we started with an initial risk at 3.8%. It's now back to 4.1%. And now if the stock happens to be trading at 72 cents, I'm sorry, 72 cents. Wow. The stock ends up trading at $38 per share. We could make 1.9%. But if it goes above 38, we've got to manage it again. So now, as we keep adjusting, if the stock keeps going up, we keep adding into the cost basis and increasing this. What we're missing out on is the stock's at $38.50 from our original position at 35.79, we'd have a gain of almost $3 on the stock, but we've given back almost $1 to roll the call premium that keeps going in the money. If you enter a married put, and now remember, of course, if I did just do a married put 2 months out, I would have to try to force the weekly income, and we just talked about how that might not work in the best case scenario at all. But if in the sense that I did buy a 2-month output, I'd be forced to use the weekly options because I need as much right cycles as I can to pay down that initial net debit. Okay. All right. Speaking of this is a good view. We might have 1 or 2 good views to use. Let's move on to Mike's question. Mike's question is regarding covered calls. How do I effectively create a stop on a covered call position? The direct answer, which you're going to hate, Mike, is to buy a put. Whether it's a married put, as we were just talking about, longer term for longer term growth in the radioactive trading techniques, or whether you're just buying an out-of-the-money put short term to go through earnings, that's the only way to create a good, solid stop. Any other stop or trigger point that exists on the market can be violated if the stock falls a large percentage in the pre or after market hours. The only thing that protects you 100% and gets you to a stop you want is paying the money to buy a put. So let's see here. What terrible stocks am I in? I think STX is one we can take a look at. Let's go back to our chain very quickly. I'm going to look up STX from last week as well, from February 19th. Whoa, I guess it would help if I took out the other symbol, huh? Sorry, Seagate Tech, STX. Pretty good, not great, but okay, let's say, it's down $1.70. Let's go back a previous day. Good. Stock on the 18th of February was at 33.11, and I'm going to go ahead and at that time maybe would have sold the 33 call for $1. So let's write that down. 33.11. Today's call at $1. Okay, well that's a pretty decent premium actually. No, it's not $1. Let's call it 95 cents. That's probably better. Again, we'll go into the portfolio. Let me put this in very quickly, Mike. Okay, covered call into our portfolio. And we've got STX. We've got 100 shares to keep the math simple. February 18th, 0 commission, 33.11. And we're going to sell this week's 33 call? Yes, 33 call. And we are going to say 95 cents. Let me change the date again. All right. So now the stock has dropped. It's down about 4.3%. Not bad. Okay, it's not bad at all as far as the decline goes. And we covered most of that with the covered call position. I just use this because it's a stock that's kind of fallen, but not too much recently. Now, the stock is below our break even. Right, our break even was 32.16. We figure, okay, we can let our 33 call expire worthless. Come Monday, we'll see where the stock is. Now, if I had put in a stop order to close the position, let's say we had just bought the stock, Mike, at 33.11, and we sold the out of the money or 35 call for only 20 cents, for example, at that time. We might have put a stop at around 32.50. Now, if the stock hits that during the trading market, we'll close the stock at 32.50, and then of course we have to set up with our broker to also close the option, all right? Because we don't want to leave a naked call sitting there in case the stock rebounds. So when the stock fell to 32.50, if it fell during the market day, we would have been able to close the position and get out. But a lot of times what we see here, let's just go to 1 month on our big chart here. All right, so we would have got in around the 18th at 33.11. The next day it opened at about 32.50 or so, so it was there as fine. But let's say we had it at 32 and we'd open at 32 here, but it gapped down. Or if it gapped down the next day. It's these gaps that kill you, because even if I had a stop order set to get closed at 32.50, if the market gapped down and opened as it did here, it's not that bad of a loss. I realize that, but it can happen with much larger losses. If the stock opened right there at 31.50, okay, if we had a gap down here, I've got a stop set at 32.50, but when this happens, if it did gap down in the pre or after market hours, my event my trigger is hit. My stop order is triggered. But the market maker can't give me 32.50 for that. A market maker can only give me what the market's offering, so I get closed at 30.25 or 30.50. The stop order is not a guaranteed out, okay? It's not a guaranteed stop. It is assumed insurance, meaning assuming that the stock hits that point during the trading day and there's no sudden gaps in the pre or after market hours. Whenever you have a sudden gap or an unexpected event, if it gaps down 33%, 40%, which we've seen in recent times, if it gapped down and it just opened at 27 due to poor news, well, your order is filled, but you get closed at 27, not 32.50. So the only way to protect against that kind of drop in a covered call position or even in a naked put position is to buy a put, to convert the naked put to a bull put credit spread, or to convert the covered call to a collar. And it's funny to think about in the sense that, let's see here, what if well, we're at expiration now. Let's say we got into the stock today, 31.69, and we sold the 14-day out 32 call. Okay, so we got into, and there it is, about $1.05 again. All right, so we're getting a good premium for this because it's been all over the place. It's been down to 28, up to 37. I'm in this stock personally as a married put position. So here's a strong covered call with a 4.4% yield. This is not a recommendation or suggestion. This stock could go back down to $28 as soon as go up to 37 in the next 2 weeks. I don't really know. All right. But if you're concerned about the downfall and you say, I want to put my stop at 30, or maybe even $30.50 just below the break even, well, that's great. But if this stock does gap down to 29 on Monday morning, your stop gets triggered, you have to sell to close the stock at 29 and then buy to close the call at whatever price it is. All right, so that's not going to give you what you want. The only way to effectively ensure the position would be to buy a put. And let's go to the 30 put at, I don't want to pay that much for it, but we're going to have to. So let's go 58 cents, more than half of our premium. I want it to be less than that. So now we set up a collar where even if the stock gaps down to $29, $28, or $27 per share, we can't lose more than 3.9%. We still keep a reasonable return of 2.5%. Okay, we had to give up some of it to buy the put, but this is the only way to ensure protection against a covered call position or a cash secured naked put, is to buy the put, whether you buy it longer term or whether you just buy it with the same expiration to create a standard collar. Any other form of stop, trailing stop, direct stop order, things of that nature, can be violated in the case of a large decline. One of the main reasons why you probably don't want to do a covered call, a brand new covered call or a naked put position right before earnings, because if it drops 25 to 30% against you, well, if you set a stop order, you're going to get filled that 30% loss. And if the average at the money covered call return right now, which I looked up earlier for a client, is only 0.8%, if I've got a 25% loss because the stock fell, let's say 30%, but I kept a 5% premium, if I am only making 8% on average with an at-the-money covered call yield for a 14 to 15-day trade, actually it's about a 20-day trade, the average is 0.8%, that's more than 2 years of generating premium to get back to break even, to get back to your initial cost basis. And so cash secured naked puts and covered calls, probably don't want to be trading them in and around expiration unless you've already got a lowered cost basis, or you use a put to ensure that downturn and still generate some premium against it. Okay, that's the tough sell. Years and years and years ago, when I first started working for PowerOptions, again about 14 years ago, we were working with two different groups. Many of you might have heard of them. FSC, Kim Snyder out in Texas, as well as Joe Hooper, Compound Stock Earnings. They were sending their clients to use our tools because we were the only ones that had search functionality that allowed their customers to put in the criteria they wanted to see for covered calls trading. After about 5 months working with PowerOptions and handling calls, helping these customers set up their searches based on what the compound stock earnings rules were and the financial success coaching Kim Snyder's rules were, you start getting a lot of calls from those new customers that you talked to when they first got started with the program. And the question was, how can I protect these covered calls that are dropping against me, or going into winter, as one of them put it, when it dropped too far and you don't want to sell calls against it, because if it moves back up, you get assigned at a lower price. And I'd say, oh, you want to buy a put to convert it into a collar. They say, no, 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 that's not what I mean. What option strategies can I use to protect the covered call? What they're asking me is what magical option strategy that they have never heard of and I'm apparently hiding will allow them to generate more premium on their covered call position using other options without increasing any risk for doing a spread or anything of that nature or selling extra calls, and still being able to protect the covered call position without paying any money for it. Believe me, if there was something secret that I could triple your premium on a covered call trade and make sure that you wouldn't lose 4 or 5% of the time, I would let you know. The trick is it doesn't exist. Without paying for the insurance, without paying for the put, any stop that is available on the market for a long stock position, a covered call, cash secured put, or anything along those lines, again, is assumed insurance. You can get hurt very quickly if you pick a stock that just moves against you. And it's not always related to earnings. Let me pull up a chart here real quick on Iconics Brands. This was a married put that I was in. I actually made a, wow, it's at $8. How about that? I had a married put on this position. I actually got out on a profit. I got in up here. I bought into the stock at the $35 range, $36 range, and I had a 40 strike put. This little decline happened down to, oh, I don't know, what is that? That's the 27 one? Yeah, it's about 27. So I rolled the put down. It lowered my cost basis but increased my risk. And then this happened. Now, these two events are equal amounts apart towards earnings, but this had nothing to do with earnings, really. There was all sorts of information about, what was it, I apologize, folks, the CFO. The CFO was concerned about the numbers they were going to report for earnings, so he left. And then at this point, the CSO was contemplating leaving, someone else was, and then he left. And then this happened here. This was related not to earnings either. This was related to the other guy leaving. Now at this point, I bought another put, right? So I had 2 puts and 100 shares of stock. And this here was the earnings, the reason why the CFO left, because I think they were asking him to fudge numbers. I don't remember. And then the other guy left, the CEO actually left, was being forced out of the board, and then the earnings hit, and then this happened, okay? So I got out with about a 4% profit on the position because I had created a synthetic strangle by owning 2 puts. So if the stock fell at that earnings, I was going to make a profit, and if it moved back up, I was going to make a profit. Well, thankfully it did go one direction. We were down 75% on the stock from where we purchased it, and we made out with a profit of 4%. Had I been doing covered calls, I'd still be down 65.5% on that investment because these happened overnight. They did not happen during the trading day. I probably would have got closed here for a 15% loss, closed out on this maneuver here for another, at that point, down to 15. That's about 50% more from where we got in. And then this drop here was the 75% from when we got in. So if I kept buying the stock hoping it would come back and then using stop orders, I still would have taken a large loss on the position. Okay, so there's no secret thing that I'm hiding from you. The best insurance you can get is expensive, just like the best insurance for your house, the best insurance for your car. You have to pay a premium to get it. And the best insurance for stock ownership, for a covered call, cash secured naked put where you may end up owning stock, is buying the put outright. Okay. Real quick, Steve asked, why did you pick Icon in the first place? I don't really remember. Let me look at something real quick. We're going to find out. I know that it matched my criteria for RadioActive Trading. The at-risk amount was there that I wanted. I'm sorry the screen is paused, folks. I'm logging into our account at RadioActiveTrading.com. My account, I should say. Okay, so let's go ahead and show the screen. All right. I logged on to RadioActiveTrading.com. I'm going to go to the track record here. Let's go to mine. And let's scroll through our listed trade. It takes a while to go through the history and to pull up the numbers and calculate the gains and losses for the historically closed positions. It's not hard-coded in. Okay, Iconics brand, 4.1%. Stock was down 65.7%. I'm sorry, I thought it was 75.6. It was 65.7 though. All right, so when I open the position, So new RPM for the RPM trade is found using the search tool that we just did earlier when we pulled up PayPal. That's the same default screen I use on PowerOptions in regards to that. I was also seen there. Has a positive earnings per share growth at the time of about 9%. Matched our risk requirement and matched the criteria I used for looking at MACD and Bollinger Bands. It had a significant decline in December, but it recovered from that in the last 20 days. So it had dropped and it had moved back up. The MACD line is matched what I was looking for, as well as the Bollinger Bands also had a strong earnings per share growth. And as you can see, the risk originally when I opened the position was only $1.50 or 3.6% on the position. All right, so we're in a good position there. Here's that first decline. Let's see, was at 36 when we bought it. Icon fell down to 33.95, so I rolled the 40 down to the 35. That increased our risk up to about 7%. Let's see here. We bought to open this put now, that 85-cent put, the August 20 put with 21.70. We were able to sell that August 20 put we bought for 85 cents, and that one decline that was coming up, we got out at 5.50. So that ended up getting us to a profitable position. Icon was at 12.25 when I closed it. That other drop was different. The one we just saw that took it down to 8. So yeah, I got out at 12.25, but I got out with a 4% profit on a stock that was down 65.7% from when I originally got in at $36. But we were able to turn a profit because of having the insurance in place at first and then adding that extra insurance as well. Okay, let me be honest here about something. I've got another question here that came in from Ashwin, but I want to cover Siva's comment first. He said, Siva said, sometimes I wonder if you just picked Apple, XOM, ETC to do radioactive trading, maybe better than trying all these other stocks like Icon. Okay. And before that, Harry said, can't be more honest than that. I think he was in regards to something else. I apologize. Let me go back here. Oh, it's not going to keep me signed in. I'm going to sign in again. Sorry, folks. I'm going to just explain something to you very quickly. What the heck? Sorry, forgot my password again. You can tell it's Friday, folks. I usually forget my password at one side or the other. There we go. Okay, so we're going to go back in. Let's go to the Open Trades Trade Tracker. And here are my positions that are open right now on, oh, Harry says in regards to the put and the cost of insurance. Yeah, it is expensive, I understand. You know, you're paying 6 to 7 to 8% of what you're purchasing for the stock to buy the put option in this technique, or taking away from your premium if you're doing a standard collar against a covered call. But that's the only way to get it. Okay, so Ashwin had asked, Siva had asked, why don't I do Apple? You know, you see Ernie here is in Facebook. He's in Delta Airlines, PayPal, Celgene, maybe stocks more along the lines of what you're looking for. My stocks, you probably haven't heard of most of them. AGO, STX, Boyd Gaming, Texas Instruments we know, and Kroger we know, and then there's this little one, IDTI. Why am I focusing on these stocks? Is because, for lack of a better term, I am honest. And what do I mean by honest? These are my actual trades in my Fidelity account. This is exactly what's in my Fidelity account for the radioactive trading portion of my personal portfolio, and that's what I show to Fusion subscribers. I am 39, turning 40 years old in a couple of months. I have about $40,000 of investment capital that I'm trading with. 50 to 60% of that is allocated to radioactive trading, which puts us around the range of about $22,000 to $25,000. And any, you know, when I go to the 60% range, so about $25,000. In order to do the married put technique, just like the covered call and other strategies, we need to buy a minimum of 100 shares of stock. Okay, well that's fine. But if I did Apple at $99 per share, I'm taking up a large portion of my portfolio to buy 100 shares of stock, what I'm allocating to radioactive trading, to buy 100 shares of stock and to buy the put option. I keep my stocks usually in this range. There's usually one or two that are above $50 to $55 per share. This is Texas Instrument. Everything else is typically under $40 per share, so I can be diversified, have 6 to 7 positions open at a time in different industries and sectors, and keep within my $25,000 that I'm allocating to radioactive trading. So why do you see me with only small positions that you've never heard of? Because those, when I run my search, let's go back to Power Options very quickly. All right, so if you're a Fusion subscriber and you see a new stock come up in my portfolio that you've never heard of, what I do when I log on to Power Options is I pull up the Married Put search, and the first thing that I do is I take my risk to my level, which is 7.5%. I'll take this down to 3. And I go into the fundamentals, and I take my stock price down to about $45 per share. Okay, if I have closed out 3 positions, I have more capital, I'll go to the higher levels. So I might have opened PayPal, but see these other stocks here, Nuance, NUAN, I don't know that one, BAX, Cadence, Linear Technologies, BWX Technologies, Computer Associates, and Goodyear Tire. That's actually pretty nice. I wonder if I could get a better premium with a 3250. Let's take a look. Probably don't want to do this one though, and I'll explain why in just a moment. Sorry folks. The one that came up in the results was the January 35 with a risk of 5.5%. I want a 30, oh, it's a 32. There's no 3250. It'd be at 480. So if I went with the lower strike at 480, 8.7% is too high. So that's why it didn't come up in my results. So that's a tough one. But I don't know if I want to do Goodyear simply because I already have 2 dividend-paying stocks in my portfolio. But this is a small dividend. It's less than 1%. So Goodyear is a potential that is a name that's recognized and would be within my range. But again, I don't personally, I don't post positions in the Fusion account, in the Mike C Power Opt account that are fake. All of these positions are my actual positions in my Fidelity or Options Express account that I'm trading radioactively. What you see in the Fusion portfolio is what I've actually traded. But because I'm only allocating $25,000, that's why you don't see Amazon, Apple, Netflix, Google, things like that in my portfolio, but you may see them in earnings from time to time. But remember, the concepts of radioactive trading will work on any stock, really, as long as you feel it's bullish in price and you have the capital and you want the risk threshold. If anyone has a thought on this question that came in from Ashwin, please feel free to let me know. I'm going to show you 2 things, and I'm going to give you my response to it. Ashwin says, Mike, is it possible to work out expected move of a stock from options premiums? Say we look at Apple with monthly March expiration options. In general, I'm going to say no. And I hate to say that, but I've never seen a tried and true method that looks at options premiums, volatility or volatility skew that has been a near close to accurate prediction of where a stock's going to move in the next 10, 15, 20, 30, 60, 90, 100 days. I honestly haven't. Over the years since I started studying options, I followed the same path you probably have. I've come across blog articles, articles on Google, things of that nature, doing search for what you've probably done. Open interest ratios, for example, the call and put volume ratio, call and put open interest ratio, put call volume ratio, put call open interest ratio, say, okay, well, or volatility ratio. Hey, because there's more calls than puts on this particular one, my put call ratio is less than 1, that means it's bullish. Okay, but when? Everyone's speculating one way or the other, whether it's 6 months out, 3 months out, or 2 months out. When is it? You don't know. So one of the tools that we have is under the signature tools. It's the volatility skew. Let's go out to March 4th for Apple, and we're just going to look at the strike skew. Okay, what do I mean by strike skew? So what this is looking at here is the implied volatility of the puts in red and the calls in blue. And we get what's called a volatility smile. All right. Now, what does that mean? I don't really know. And it depends which article you read on the internet, because some people will take this as a regular indicator, meaning that because the implied volatilities of the out of the money and in the money options are higher, then the projection is that it's going to move in one direction or the other. Well, that doesn't help you any. Okay. That the volatility won't stay here in the normal. But you read other articles and they're contrarian. They'll say, oh, well, that means that it's going to stay at the mean and it's going to stay in sort of these at the money strikes because there's too much volatility on the outer wings and the stock wouldn't move there. Okay, that's great. So who do you believe? The time skew is what is more commonly used, by the way. And what the time skew is we have to throw this one out. Okay, this is today, so let's just throw that out because all the volatility's got wonky. And this isn't a smile. You know, you're picking a strike price, but this isn't a smile or a skew. It's just sort of a straight line. Nothing's changing over the next 4 or 5 months looking at the at-the-money strikes. Let's go out of the money, let's say up to the 101. We see the same thing. The volatility, of course, is going up as we go further out in time. That's kind of what we'd expect. This one's particularly not telling me anything, and it gets kind of skewed when you throw in these weekly options because they take up more of the expiration cycle without giving you a real gauge of change in the implied volatility as well. Okay, so that's one of the reasons. Now, if we go to just the straight chain for Apple, and this will take us to the call and put chain. When you compare prices, you know, and you say, okay, well, this double, what you're really looking at is the annualized naked yield or the annualized return. And just like anything else, you'll see the annualized return is lower if you go further out in time. In the 5% chance or 6% of the time where you see implied volatility is higher further out in time, 5-6 months out in time, and the annualized return for an option is higher 6 to 5 to 8 months out in time, it's because it's already known that there's a special event coming out in that time frame that won't affect the near-term options, not necessarily earnings because we know they come every quarter. This is something different. Land lease for the biotech stocks, it's a phase 2 or phase 3 ruling where sometimes you'll see that it's better to sell 5 or 6 months out than sell week by week by week or month by month by month. But if I'm selling a covered call against a biotech stock that has a phase 2 or phase 3 trial coming up in 5 or 6 months, when that ruling comes out, the stock could drop 80% of its value. Does me no good to be in a covered call in that situation. Or it could gap up 60%. And sure, I'll make the return I wanted on the covered call, but I didn't see any more of that upward movement. So one thing that is factored in, I tend to use, and you've heard me talk about this before, is the overall market sentiment, that the market sentiment indicator, where we look at the 13 broad-based indicators. And one of them is the put-call volume ratio for the S&P 500, a broad market measure. Things such as the RSI, the MACD gap, the number of days over the SMA 20. Ernie historically tested all these parameters and about 24 more, and he found these ones were the most indicative of when there would be a market move in one direction or the other. When you see 3 of these 13 symbols go to bearish and none are bullish and the remaining 8 are neutral, that might be a light buy warning because they've gone to bearish, so they typically would revert back. Or I'm sorry, there would be a light sell warning. And then if you see about 4 or 5 of them in bearish, that would be a, let's see here, let's scroll through. There's some of the light buys we had recently. We go further back, of course, there were some strong buys that occurred, I believe. There's the very bullish buy on January 20th and January 15th. The bearish sell I don't think we had until last December in that case. But Ernie found that as far as the SPX goes, using the put-call volume ratio is one of the indicators that works pretty well. I can't guarantee that that's a factor for all of the different ones then. Okay, all the different stocks individual. Every stock is different. Okay. All right. Let's see here. Oh, Siva, no, the market indicator is not available. The market sentiment is not available for individual stocks right now. These positions are just for the SPX and looking at the broad market indicator. And Siva, your other questions you had asked, can you show us a way to find better stocks? Well, some of the criteria that I use, and I'm not going to guarantee you're always going to find better ones. Ernie has been using the Bollinger Bands for some time, okay? And there's a percent BB20. This is where the stock is now in relation to the upper or lower Bollinger Band. And he's got an article there as well, and he's written. A lot of things I look for is I look for this stock, the MACD to be above the cross signal. Okay, so I want the MACD to be at a higher range to have crossed the signal line, but maybe recently. One of the things that I've tried to do, this is going to sound confusing at first, but I'll show you. I don't think I'm going to find any on this search. But I'm going to look for stocks maybe where the MACD has crossed the signal less than 3 days ago. But I want the MACD to be positive and the signal line to be negative. Okay, there's nothing in that list. That's okay. There's probably nothing in the S&P or the IBD CAN slim. So let me change it to no lists. See if we can find something. No. Okay. What do I mean by that? The MACD line. It's something I use, and it's not always right, but it's something that I'm kind of looking for a movement for, and I'll show you in a second here. Maybe I need to go further. Let's just take a stock. We'll go to big charts, and I'll show you the two things very quickly that Ernie uses, and I'll point you to the article that he uses as well. This is Suncor Energy. It's just a stock that's there. No research or anything done on it. I don't even know what this stock's going to look like. I'm going to cut it down to a 6-month chart. For my indicators, I'm going to use the Bollinger Bands. And my lower indicators, I'm going to use MACD. Let's just put volume in there. And RSI, I don't use it that much. I use it more of an exit kind of thing. This one is really close, though. Let's go to 3 months so I can get a better depiction here. Let's go 2 months so I can see a better depiction here. This actually looks pretty good. Something I would normally get into. What I was talking about with the MACD is down here at the bottom. This is our MACD line here, okay, the blue and the red. And what you typically look for is a crossover. Is it a lagging indicator? Maybe. But this was kind of what I was looking for. But really it was more along the lines of this. So what I was looking for in that filter that I added were stocks where the MACD was positive. That's the blue line. The signal line was maybe still negative, and they had crossed over within the last 3 days. So look what happened the last time this crossed over, where the MACD sort of dipped down, but then it crossed over again. Well, we went from about $21 up to where about $24 right now. Not a great move, but this stock is also, what's up at the top here, these are the Bollinger Bands. So in general, our philosophy is to look for stocks that are trading up near the upper range of the Bollinger Band, or potentially for one that's broken out. This one's trying to, but it just hasn't yet. When you see it close above the Bollinger Band, that's typically what Ernie looks for, and then usually it'll settle, but then have a run back up. Honestly, Suncor looks kind of good for me. I might consider that as a married put next week. So those of you that are in Fusion there, the Suncor SU, yeah, then again, I'm not really fond of the energy industry right now, so maybe I'm speaking out of turn. The chart looks okay for something I'd normally enter. I don't know if I like this industry at all. At this time, I should say. All right, so Siva says Buffett invested that last quarter, I think. Okay. But those are some of the things, using those technical indicators. I like using the MACD and the Bollinger Bands. I'll send everyone a link to it. If you go to the long call tab or the long put tab, there's an article Ernie wrote a while ago called Bollinger Bands for Long Options. Let me just click on that. All right. And I'm just going to send the link to everyone here. This is kind of Ernie's thoughts on using the Bollinger Bands. I think we may even have some more information there on the blog as well in relation to the Bollinger Bands. All right. Great question has come in. Sorry, I just lost it. This is from John. John says, I'm a newbie. When you do a covered call, when you buy covered calls, do I have to wait until expiration to close, or can I close before expiration? You can close at any time. General rule of thumb for a covered call position. Let's take Cal-Maine. Let's go back in time again. We're going to take Cal-Maine and go to our chain again, John. And I'm going to do the same thing we did before. Let me close out some of these windows here. Good. Good. Okay. I'm going to go back just a week. Maybe two, but let's go back a week to February 19th. Oh. Let's look at a chart and pick a better time. Here we go. Oh, it's back up to where it was. Okay, so this is a nice little cup and almost trying to form a cup and handle kind of thing. It's been down really low here. Let's find, no, this is good. This is good. Let's say we got in yesterday. Okay, let's go back to our chain. Let's go to yesterday's date. There we go. Okay, let's say we got into Cal-Maine at 54.11 yesterday. And at the same time, that's 22 days left. We only have standard expirations. Fantastic. So let's say we sold the March 55 at 120. Just an out-of-the-money covered call, John. Okay, let's put that into our portfolio, as we did with the others. All right, so let's enter a new strategy. Let's enter in our covered call. And CALM. We can leave. Now, let's go back a day. And this was 34.11. Oh, incorrect. 54.11. And we sold the March, because it doesn't offer weeklies, 55 call at 120. All right, so got some articles for you as well, John, that I'll show you in just a second. So here's our covered call on CalMaine. Excuse me, folks, let me highlight this just a little bit here. This is where we're looking. It's in this area here. Now the system knows, of course, that we sold this call, and we sold it at 120, but the ask right now is at 80, or the midpoint, excuse me, is 80 cents. So we've only made 40 cents against it, or 33.3%. If I'm concerned about the stock continuing to fall, and I want to hedge this a little bit more, I could consider rolling down, buying back the 55 call for 80 cents, and maybe selling the 52.50 for a higher premium. Okay? That might not be what I want to do right now, but the key is, just like your stock, I can buy to close this call at any time. On the downside, a good rule of thumb, or a common rule of thumb that's used, is the 80-20 rule. Meaning, John, that if I sold this for 120, if the stock moves down and my call drops 80% of what I expect to make, in other words, I lose 80% of this 120, or it's down to $40 or $35, I may consider buying it back at that time and maybe looking to roll to a lower call because I've made 80% of what I expected to make. On the reverse, if the stock gapped up to 65 and my original expected return here, oops, sorry folks, that's not clear. If my original expected return on this covered call, let's go to that position analysis view, was 4% if assigned. Well, if the stock, for whatever reason, gapped up to 62 and I could buy to close the call and sell to close the stock today and make 3.5%, I might take it off the table rather than risk having it pull back in time. You can close the options at any time. You just have to decide if it's right for you. So for example, we opened this covered call position. We generated $1.20 in premium. We were looking for a maximum 4% yield if the stock stayed above 55 at March expiration. Now, the stock has fallen, and it's fallen below our break even. The 120 minus our purchase price of 44.11 put me at a cost basis of 52.91. The stock's now at 52.44. So I am losing money on this position. Now, before I do any adjustments, I have to, of course, reevaluate my position, just as I did when I opened up the covered call. Meaning that when I opened this covered call, it's because I had the expectation the stock was going to continue to move up, might be trading above 55, and I'd make that 4% yield. I was comfortable having a break even at 52.91, i.e. the downside protection in place. So if the stock fell, could fall down to 52.90 before I started losing money on this position. However, that did not happen. The stock dropped down to 52.44. Now I'm in this trade, I probably know the reason. Was it earnings day? Was there some other news that came out? I'm probably aware of why this dropped. Now I have to consider what's going forward. If I liquidate now, I'm going to take a loss. Okay, we'd sell the stock at 52.44 and I have to pay 80 cents to buy to close the call. Okay, so really get 52.44 back, pay 80 cents of that back to close the obligation of the call. We only get 51.68 back or so, and we originally paid 52.91, so we're at a loss on the position. Can I protect by rolling it down? Maybe. So we could say, okay, let me see what would happen. We buy this back here, the 55. I was saying 80 cents, I believe. Yeah, so that's about a good midpoint. So we buy it back for 80. We still keep that 40 cents premium positive, and now I sell the 52.5 for maybe $1.65. Somewhere near the midpoint range. Okay, so now what's the difference? We keep 40 cents here and gain another $1.65, so we're getting $2.05 in positive premium after 1 day of trade. But we lowered our potential return, our potential assignment by $2.50. So we're going to have less than a 4% return in this case because we had to roll down. And actually, it's not almost worth it. What did we do here? We lowered our break even down to 52.06 by rolling the call down at this point. But now if the stock recovers and goes back above 52.50, we're only looking at a 0.8% yield. Or we'd have to buy back our March 52.50 call and sell an April 52.50 or an April 55 and continue to roll in that fashion. But you can roll at any time, John, is the key. Okay, if the stock hits your trigger point, it hits your break-even point, whatever triggers you set for rolling or adjusting, you can buy to close your call and sell to open another call at any time, whether the stock has moved up or whether it's moved down. Unless, of course, it moved up enough where you got called out early, then you're just out of the position and you took in the maximum profit that you wanted to see. All right, Ashwin asks, can you search for broken wing butterflies or do you use the custom spread trades? Yeah, we don't have a search for broken wing butterflies right now. So you would have to use the custom spread to try to set that up. In that case, the broken wing butterfly. Okay. All right. Well, ladies and gentlemen, it is 5:32 p.m. Eastern Time. I do not see any other questions that have come in right now. If you have a last-minute question, please feel free to go ahead and ask it. Let's just go back now to our screens here. I just wanted to remind everyone, if you haven't done so already, you want to make sure that you just go to PowerOp.com, put in your first name, last name, and email address, and you can register for the 14-day free trial. You have full use of the tools that we showed today for 14 days. After that, of course, our levels of subscription, we do offer now an end-of-day subscription. The end-of-day subscription is $40 per month. You just get updates at the end of the day, but you can still do the search and analysis and everything, but the data is going to be a day delayed. Our 20-minute delayed service, where updates come in for the stocks and for the options every 20 minutes, is $60 per month. We also offer a real-time service that's $100 per month. So every time you refresh a page, run a search, or look at your portfolio, you're getting the numbers and the calculations at that very instant. And on top of the 20-minute delayed and the historical, sorry about that, you can add the historical suite of tools, and that's $40 additional. So 20-minute delayed plus historical is $100 per month, and then the real-time service plus the backtesting tools is $140 per month as well. All right, so coming up next week, Kurt, oops. There we go, that's what I wanted to. I'm sorry, Kurt is going to be hosting a presentation Tuesday at 12 noon, sort of an introduction to the radioactive trading techniques, those married puts. If you're interested in that, you might want to check it out. Tuesday at 12 noon, you can register for that at RadioActiveTrading.com. We'll probably announce a webinar next week, probably Wednesday at 12 noon Eastern Time for power options, going over one of these specific tools as well. You'll be able to register for that at PowerOp.com, and then of course next Friday at 4:30 p.m. we'll be back here for our open discussion and open forum presentation as well. Okay, and Jim says he opened a broken wing butterfly on Russell 2000 today so that the delta is near zero. Good. He says he does do this at least monthly. So I guess he's doing a couple of those butterflies, one or two of those butterflies monthly to get close to that near delta. And butterflies are pretty interesting. The broken wing butterflies are pretty interesting. I don't mind the broken wing butterflies. I just don't like the iron butterflies, trying to pinpoint a strike price directly where you can take the full loss if the stock moves or the index moves 4 or 5% above or below a specific strike price. Never been able to do that. Did like the iron condors better, but I found that over time I was more successful doing a bull put credit spread or bear call spread and then trying to leg into the iron condor later, because too many times I was taking losses on one side or the other of an iron condor. Okay, Jim said his was an iron butterfly. Good. Okay, well, good luck. Jim and I have talked before. He has more success with those kind of elaborate spreads than I did when I traded them. Butterflies were always difficult for me to pinpoint the strike price. The indexes and ETFs, that's one thing we always recommend, Jim. You know this, and you've heard me say this, but if you're looking to do iron condors, the four-leg trades that are neutral positions, or the iron butterflies, or even all call condors, or all call butterflies, or all puts, it's best to focus on the indexes and ETFs that have lower volatility. Because they are neutral strategies, and you want something that is not going to move that much as well. All right. Well, ladies and gentlemen, thank you again for joining me this afternoon. Remember, if you think of any questions later on, something comes to your mind or something about the presentation, please feel free to send me an email anytime to support@powerop.com. And remember, you can also call us during market hours at 302-992-7971. We've got contact links at the bottom of every Power Options page. Thank you again for joining me this afternoon, ladies and gentlemen. Have a fantastic weekend, and we will see you all soon next week at one of our other presentations. So take care, everyone. Good night.